What you're about to see is an exclusive clip originally released only for Wall Street Unplugged Premium members. We're lifting the curtain and giving you a glimpse inside. Now check us out. PPI came out today. I thought it was a really, really big deal. I mean, the market's pulled back. They're starting to gain a little momentum again. You know, it's still down a little bit, but we're doing this midday. They fell right after PPI came out. We were expecting a 0.2% gain. We got nearly a 1% gain. That is very, very big. I mean, you don't really see that much of a miss. And it's the biggest monthly increase since June 2022. If you're not familiar, that was when inflation was surging to 40-year highs. The core PPI, excludes food and energy, also rose 0.9%. The forecast was 0.3%. What were your thoughts right out of the bat with this? Because I thought this, I'm not going to say it's a game changer, but it was a very big deal to me when I saw this report.
It definitely shows that inflation is uptaking, and we talked about this yesterday with CPI, to your point. We didn't think it was near as positive as the market took it. They're obviously looking forward and through that. A couple of interesting things on the PPI is trade services rose 2%. Mm-hmm. So that's essentially looking into the amount that wholesalers and retailers are hiking prices, thinking that will follow through. Remember, we talked about this oil spill making its way downriver. You know tariffs are coming at some point. We've had the talking heads and a lot of people anti-Trump saying we would have already seen it. We talked about this yesterday with delays and such. It's not here in full force yet. If this is the start, you should expect this trend for the next few months. That'll be countered by monetary policy, in my opinion. We'll see how that plays out. Frank, 50% or two-thirds of this number is related to services. And did you see vegetables? You're trying to be healthy.
No, I didn't see vegetables.
Vegetables were up 38%.
Were they really? I didn't see that.
38%, which is absolutely crazy. But we don't need to get into the doubting of datas right now, but that's the overall thing. Frank, 5% increase, and I don't know the percentage breakdown in it. It's not important because it's just showing you what's all in these numbers. There was a 5% increase, Frank, of portfolio management fees. You can ignore that one, people. That is not a big deal. But man, you put it on a chart, it's like, whoo, looks great.
Yeah,
anyway,
that's insane.
So yeah, it came in hotter than expected. I'll let you opine from here. But if this is the start of a trend, we'll see. This is why you got to be patient. I wouldn't go crazy over this one number because these are going to be lumpy around trade deals, in my opinion.
You know, we wanted the impression over the past couple of months that, well, we're not seeing inflation. We joked around because everyone said, we're going to see inflation from the trade deals and tariffs and stuff like that. We haven't really seen it until now. I mean, you're looking at 80% of that PPI was from services. You mentioned that just now. This component rose 1.1% in July. It's the largest gain since March 2022. Okay, so within services, which is alarming, is 30% of the increase came from a 3.8% rise in machinery and equipment wholesaling. That's tariffs. You said portfolio management fees surging 5.4%. I don't know if that's the rise in crypto, and you know, since these funds, brokerage firms who manage money charge much higher fees, but those fees have gone up. Airlines were up 1%. I told you, you know, I'm flying now. It's insane how much it is to fly.
That's not tariff related.
It's just price hikes. But I say this is scary because we really need rate cuts right now. We really need them. I mean, housing is more unaffordable than it's ever been. And, you know, when you look at the data and you look at the median household necessary to purchase, you know, the median priced home, it's $124,000. Okay, it's 57% higher than the current median household income, which is around $80,000. Okay, that's Charlie Baylor. That's great stuff. I'm going to show you a chart. But just going to see, if you watch us on YouTube, I got some charts to show you today. I'm going to explain them if you're not. But just looking at this gap, when you see the picture of housing, of where it is and the affordability, it's insane when you're looking. And this is going back to 2000 and probably 5 or 6, and you see this incredible gap over the past couple of years in 2024, 2025. It's 57%. That's the affordability gap. It's never, ever been even near that, right? So the housing market, what that means is the housing market is just not going to contribute, right? People cannot afford to buy houses, new homes. It's very, very difficult for them to buy new homes. And that has been, throughout history, a huge driver of economic growth. We need lower rates. You're looking at what companies have said in the past few weeks on the earnings call, Daniel. We covered this. Like Kava is down 16%, you know, after lowering same store sales. They said persistent labor shortages and straining operations. The stock was 175 earlier. It's now down another 5% today. It's trading at 67. You just can't afford to miss a lower comps when you have a high flying valuation. And just to show you how this valuation, how high it is for Kava, I mean, it was 175. It's 67 now. At 67, still trades over 100 times forward earnings, while growth is clearly slowing. Remember, we got to talk about growth. You look at Chipotle's another one, down 30% year to date, 52-week low. Stock still trading at 32 times forward earnings, a huge premium multiple to the S&P 500, which is 22 times forward earnings right now? Huge. You know, it's okay. 32 is not necessarily expensive if you're growing, but they're not growing as fast. When it comes to companies warning specifically about the consumer, McDonald's, right? Listen to this. Procter & Gamble, Pepsi, Colgate, Kimberly-Clark, this is all this quarter, last couple of weeks. Airlines cut guidance, blaming slower spending from consumers. They're worried. You have Target, Walmart, Foot Locker, Lowe's. There's tons more. These are just some of the ones I'm naming that I saw. Now it's starting to show up in the data. I said yesterday that the CPI was not positive. I don't know why people thought that number was positive. I have no idea. I mean, core is growing over 3%, right? It's the first time you're seeing where it was a reversal of the trend where I said inflation was absolutely crashing. It was a reversal. It wasn't that good where people are saying this increases a chance of a 50 basis point cut by the Fed in September. Are you out of your mind? I mean, not on that report. I thought the previous 3 reports of CPI, I would have said that. This report, no way. And you look at the PPI today, and you're looking at the chart, and you could see how crazy it is when you really look at the chart in the PPI. And I have a chart up here, Daniel, and you just see it through 2022, mid-2022. You have these blue bars, and then you see the bars kind of all over the place here and there. And now you're seeing this blue bar on the right side all the way, mid-2025 is skyrocketing again, okay? That's the producer price index. That's going higher, 0.9%, and it's the highest it's been. You could see this. I drew a line on the chart in, mid-2022. It could be a one-off, but the CPI came in. You're looking at, which I didn't think was positive. The PPI came in, which I didn't think that was positive. You're throwing in, rates where I don't know if we're going to see those rates come down as quick now. We know that Powell's leaving in May, but we're expecting 2 rate cuts at the end of this year. I don't know if we get 2 rate cuts, especially if we get weak data again. And you look at job data, challenger data, it's not the best gauge, and I get it. Everyone's worried about, the statistics, the job numbers, are they real, are they not? But, challenger data, it's showing the most layoffs since COVID. When you look at the job market, and we brought this up, here's another chart with the job market. And after the revisions, Daniel, you just see this chart. I mean, it's crashing since the beginning of 2022. I mean, it's at the low. So we're seeing it show up in the data now, which we were like, okay, this number is good. Jobs are strong. Even wages, we're seeing it show up. So you look at today, too, not just the PPI. Deere getting hit. They said the consumer's slowing. Tapestry getting hit a little bit. And I'll give Tapestry a pass because the stock's been up tremendously. And they have the Coach and Kate Spade brand. And I love what they've done with that brand where it still seems like you could say, hey, this is high end. I'm not talking about Gucci. I'm not talking about, Louis Vuitton. But these are names that people buy that you still feel like, wow, these are great bags. This is a great brand. That, they're considered a little bit high end, but their prices are affordable for middle class, and they increase their total addressable market, and they've been doing great. More than double in the past 12 months, down 13% today. Management's still bullish, but they will blame tariffs for the miss. Birkenstock. If you're not familiar with Birkenstock, if you have daughters, you're familiar with it because I had to buy my daughter a pair of these, which she loves and talks about every single day, and brought them on a trip and everything when we went away to Ohio. But they had a huge currency headwind, and largest in the company's history, they said, and it was a 3% hit on margins. If you're not looking at financials or you don't do models, I can't tell you how big of a 3% hit on margins quarter, from just, this quarter compared to the last quarter is. It's massive. It's massive. And they said it's due to tariffs. Well, it is due to tariffs because they're seeing rising costs for imports from its suppliers. They did say, hey, you know what? We're passing off these higher costs to our consumers, and they're okay with it right now. But still, the stock's down a little bit. But Dan, I'm saying I'm nervous, and I'm telling you I'm nervous because we need rate cuts now. And if we have rising inflation, which we're seeing from the CPI and the PPI again, you could say those two are one-offs. Let's see. But it's difficult to aggressively lower rates by the 1.5% over the next, say, 12 to 15 months if you're seeing inflation now up over 3%. If you're seeing PPI continue to rise like this. So if rates stay high, you're going to see a little demand for housing, again, which is one of the largest, if not the largest driver of economic growth. You're going to see funding slow. You're going to see IPOs slow. And we're likely going to see huge outflows out of U.S. stocks. And you know where they're going to go, Daniel? Into international stocks. Where if you look at the developing countries, and I got a couple more charts here. So I did a little bit of research for this, just for you guys. Okay, this is why you pay for this. If you're looking at countries that cut rates in 2025, I mean, they have a list of 25 on this list, and I think there's just 3 that hiked, but the U.S. hasn't raised rates this year. It hasn't lowered rates this year, right? Which is weird, right? You'd think they did, but the last cut was, I think, December 24. I'm going to go over a list of countries here. Switzerland, Thailand, Denmark, Eurozone, Sweden, South Korea, Canada, Malaysia, China, New Zealand, Czech Republic. Again, I have this list up right now if you watch on YouTube. Australia, UK, Norway, Peru, Hong Kong, Chile, all these countries have cut in 2025. And it's a big deal because they've been aggressively cutting here. I mean, you go South Africa, Mexico, Colombia, Russia, Argentina, Turkey, all these countries have been cutting while we haven't. And if you look at the performance here for these countries now, and the global performance, which is 2025 year to date, take a look at this. And if you're not watching on YouTube, I mean, you're looking at Greece, Poland, Spain, Austria, Vietnam, South Korea, Italy, Colombia, South Africa, Mexico, Germany, Peru, Finland, Chile, Hong Kong, Singapore, Brazil, UAE, China, Sweden, Norway, Belgium, Kuwait, United Kingdom, France, Netherlands, Switzerland, Japan, Canada, Taiwan, Ireland, Qatar, Australia, all outperforming the U.S., some of them by an incredibly wide margin. Most of those countries, outside of the last 6 that I named, so 20 before that, 25 before that, are double the U.S. returns. So what does that mean? Where am I going with this? We should be lowering rates, and we're not. And the fact that we didn't over the past couple months, now it makes it more harder to justify. And I feel like if there's a match, a one-on-one between Trump and Powell, the momentum has definitely swung towards Powell when it comes to not lowering rates. We're going to Trump. He wants to lower rates aggressively. These two reports, and, make no mistake, the markets are forward-looking. We're at all-time highs, mostly because we're expecting huge rate cuts over the next 12 months. Now, I don't know if we're going to get them. And again, you could say these are one-offs, but for me, what this report did is say, hey, Dan, you and I have been like pedal to the metal, right? Hey, got to go in, buy stocks, especially over the last 12 months, 18 months, we've been, all in on stocks and doing very, very well. This, to me, is a signal that you have to take a little risk off. Because if we do get another number like this next month, look out. It takes rate cuts off the table, and it's going to impact the markets. And I think that's worth taking some profits here, which is why you're seeing the markets get hit a little bit after this report.
It definitely continues to be clear as mud, and it will continue to be so. One thing that stuck out to me on this lumpy data, Frank, is one of the largest increases was in diesel fuel and jet fuel. But yet, gasoline prices fell down, and also pipeline transportation, or transporting energy in some senses, fell down. And you know what's weird about that? And this is month over month, I understand. However, if you look at the price of oil, which my guess is, Frank, has a pretty good influence on diesel prices, jet fuel, and gasoline. If you just look at 3 months, on May 14th, the price of oil was $63.15. Today, it's 60 cents higher at $63.76. Now, in between there, it spiked to 75 and back in June. It went to 75 and back below 65, all within June. So my point here is, yes, month to month, these look scary. Unfortunately for us in the investing world, Frank has hit it right on the head. Maybe this is a one-off, maybe not. It takes time to figure that out, and markets are going to be volatile in between that. But I just wanted that shocked me when I saw, even your boy Jim Cramer pointed that out. He's like, wait a minute, jet fuel is surging, diesel's surging, and yet oil and gasoline are down? So I had to agree with him on that. That was kind of funny the way he said that. So the inflation came out at 2.7 the other day in the CPI. Now the PPI comes in hot. What's wild is I have a lot more faith in trueflation. I've talked about this several times than any other government data, because this is a more tech-driven guy, and I don't believe either side of the politics. You guys know that. This is saying trueflation has it at 1.99. Now
that's gone up from when you mentioned it a couple days ago, right?
Q on that. Since yesterday, it was 1.84.
Yeah.
A week ago, 1.75.
See
that's
that?
a 13.7% difference.
Big.
A month ago, same thing. Well, not same thing. 1.71, which was 16%. But a year ago, it was 1.96. Now, this is according to Trueflation. My point is there is such a wide gap. It's like Amazon's EPS estimates. We might lose $2 billion, we might make 30, okay? The gap between the real data, or more real data in my opinion, versus our data is going to be confusing continuing from here forward. And then you got rate hike odds. Frank, I saw just this floor this morning. CNBC took a snapshot of it. What do you think the odds of a September rate hike were after the PPI?
Rate hike or rate cut?
Or cut, I'm sorry, Thank you. It was after the PPI number, because at the very bottom of CNBC was showing the PPI coming in at 0.9, much higher.
I think it's very, very high for a 25 basis point cut. I think it's very high, isn't it?
It was over 90.
Yeah.
Still this morning.
Yeah.
Now, again, that's CNBC. I have to watch them because the other guy on the other microphone tells me to. Just kidding.
Hey, we need to know the consensus.
And you got to know what's going on.
We need to know
there,
what everyone's thinking and what the consensus is, and that's how you get it. That's how you beat markets.
The point here is, again, with the wide gap in between there, they have a 90+%. I think it was 93. Maybe it's gone down a little bit. Polymarket, which is driven by more up-to-date data I don't know if it's more up-to-date because CNBC has some partners too, but there's some money behind this. They have it at a 73%. Now that's down a little bit. There's a big percentage difference there. So it's clear as mud. Frank, if you want to, I agree. If you want to take some gains off the table, that's fine. But don't get caught up in thinking that this is by itself the new trend, because honestly, they're going to be lumpy and we don't know.
Yeah. I mean, listen, the lumpiness has been skewed towards the downside, though. I mean, even though it's been a little bit lumpy, but it's been better than expected. This is clearly showing that inflation is not slowing anymore and it's going higher. And that's where, okay, is this a trend or is this a one-off? But now you have the tariffs and everyone's like, okay, and even we were like, okay, where is it? Where are the economists saying this is going to show up? You're starting to see show up what a lot of these companies are saying. When I look at this, I don't see that subsiding next month or the month after. I think it's either going to stay the same, which is going to show, inflation kind of not trending lower, which is not good. And look, to be fair, AI, crypto, digital assets on fire. I mean, these are huge growing secular markets, massive institutional adoption, institutional money's coming in. Companies within this trend will continue to do well as long as hyperscalers continue to increase CapEx. Those who believe the hyperscalers are not generating strong ROIs on their massive CapEx spend, I just want to let you know that the combined revenue for the big four U.S. tech companies over the past 12 months, they generated $1.53 trillion in revenue over the last 12 months, a record. Okay, you have Amazon leading the charge. Of course, they sell a lot of items on their site, which is nearly $600 billion in revenue. Apple second, 382. Google 318. Microsoft 237 billion in revenue a year. So you're seeing this revenue really take off, all right? And it's at record levels. So you can't say, okay, they're not seeing a return on their investment because their results have never been greater than they've been. I mean, I was joking with Daniel before when it comes to like AMD and another company we're looking at, when you shed the garbage from your company, say if you have 10 different segments and 3 or 4, say if you have 5 segments and 3 of them aren't doing well, but 2 of them are doing great. We've seen that with IBM. We've seen that with, just AI companies. We've seen that with AMD. As you shed the divisions that aren't doing that good, your company now becomes more of a pure play on the growth trends. But when I look at Amazon, Apple, Google, Microsoft, when you analyze those quarters, they'll have 5 or 6 divisions, and every freaking division is up 25% from last year, 35%, 40%, 20%. They never have a division. They're not like AMD. They weren't like IBM. They're like, companies just shifting their resources into the more growing industries and more growing segments, right? And it's just, when I see these companies report, it's across the board. It's not like, wow, AI's doing great. Gaming's doing great. They're making money on gaming. Who's making money on gaming these days? Every single freaking division, their social media platforms, their cloud platforms, the AI platforms, everything across the board that they're doing, they're all making money across all the divisions. These guys are definitely seeing strong returns on their investments. Now, real quick, how do we play this? Be careful owning super expensive consumer-related companies right now. Chipotle, Kava, Tapestry is one of the best performers S&P 500 this year heading into earnings. The only apparel retail company out of top 25 performers in the S&P 500 that made that list. So, they got hit, and I didn't think the quarter was horrible. But if these names report another weak quarter or a quarter that comes in under expectations or those analyst expectations, they're going to fall a lot further from here. You have to be careful owning these things. Yet, if inflation moderates and we see this turn around, this isn't just a one-off for this quarter with CPI and PPI. We see rate cuts later this year into next year. Trump follows through on America First, more manufacturing jobs. Deregulation's huge. It's going to be a massive buying opportunity for a lot of these names that got nailed during this earnings season, and for many of them that are going to get it right. But the PPI, I think the biggest takeaway for me is it created a huge uncertainty headwind, which we didn't have in the market, where people are like, hey, I think inflation's okay. We're okay. We're going to get rate cuts. This creates uncertainty because now you're like, all right, we got to wait another quarter. So what happens in the next 3 months? I think it's very dangerous to go full risk on in the next 2-3 months, even in the next month before we get the next report, but going into the quarter, into next quarter's earnings, it just creates this uncertainty to say, okay, at least over the next 30 days, that if we get another report, it's going to be really risk off. You might see crypto get hit and small caps pull back a little bit more, but nobody really expected this number to come in that hot, and it really caught a lot of people by surprise. You want to say it's a one-off? Fine. Nobody knows what happens in the future. If it's not a one-off, stocks are going to come down from these levels, and that what has me a little bit worried. Not saying sell everything. I'm just saying take a little risk off the table, take some profits. We've done well in so many names in our portfolio. Just be a little careful here, because this was something that I think you should take very, very seriously. I don't say it off of one report, but this caught, when you catch Wall Street, everyone, all the analysts, economists off sides, you have this uncertainty. We saw the yen carry trade do this a couple of years ago. This is kind of the same thing. Like, whoa, wait, what happened? I thought tariffs weren't going to make a big deal. Now we're going to see over the next couple of months if they are, and that's going to remove that big catalyst of lower rates sooner than later, and we could see stocks get hit because of that. So just be a little careful here.
Be cautious.
I think you'll really love Wall Street Unplugged Premium. The Wall Street Unplugged Premium is my members-only podcast where I dive even deeper into this week's events. I'll tell you specifically what moves you can make today. Specific investment ideas I'm recommending and tracking each week. Also, the news we're picking up from our network of insiders. And becoming a member is super simple and super cheap. So head on over to WSUoffer.com to check it all out. Sign up today and you won't miss a thing. That's WSUoffer.com.